One reason why we've been able to grow at the pace we have is we've been able to retain a lot of our people over the years. And a lot of times in the brokerage business, you see a lot of people like 2 steps forward, 1 step back, where people are changing brokerages and administration staff are leaving. So I've always been of the belief, if we pay our team right and we treat them right and we incorporate them into our overall business model and they can profit right along with the company, it keeps our retention levels very high and creates a very unique corporate environment to work within.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Cory Wright is the host of the Vancouver CRE podcast. He's also the founder of William Wright Commercial Real Estate Services. Cory, welcome to the show.
Great. Thanks so much for having me. I appreciate it.
Hey, man, pleasure's mine. 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Sure. So going back probably about 10 or 11 years ago now, I got my real estate license. But prior to that, I was in the hospitality industry where we bought and sold restaurants and pubs. Through that part of it, we became commercial landlords and felt there was a niche in the brokerage market that we could eventually roll ourselves into. So we did that. And then fast forward 9 years now, we've got 5 commercial real estate offices in the province of BC, and soon to be 2 more that will be opening later this year, which will give us 7 and give us the most coverage and most offices than any of our competition in this marketplace.
Wow, that's really, really cool. So you were in the hospitality business. You were buying or brokering restaurants? And
we were buying and selling them, and through that, we worked with a lot of brokers and just felt that we could probably do. As everyone feels, there's got to be a better way.
Right.
So we sort of thought there was a niche in the market there that we could exploit. Mm-hmm. And when we exited that industry, we went into the brokerage business just as a broker, not a brokerage right away. Wanted to test this theory to see if how I think it could be done, it could work. 18 months later, we opened our first office. And then 9 years from there, now we've got a team of about 45 to 50 across the province. What
were some of the things that you said, man, I think this is something that we can do better than what the industry was already doing?
Well, I think, I don't want to sound bad from an industry standpoint, but a lot of things like common sense that I think that general business people will deal with, we didn't feel that was happening the same way as a client for the brokerage community, where we felt we were doing a lot of our own legwork, a lot of our own DD work, having to make a lot of our own phone calls, which to me, I always thought if I was hiring somebody, they would take care of a lot of that. We found out that wasn't the case. So coming into it from a tenant perspective, a landlord perspective, and a business buyer and seller, I thought that we could sort of enhance the brokerage experience, focus on customer service, bringing a lot more to the table. And we went with more of a quality versus quantity type concept versus having, hundreds of brokers. We wanted to have a smaller group throughout the province, focus really hard, train them really well, invest in them really, really well. And that's also been very reflective in the clients that we have. And I think a lot of companies forget that no matter what business you're in, the most important asset you have are your people. And we focus solely on that.
That's really, really cool. But building out, I hear you say all this, and then I start thinking, gosh, that sounds like, training. That sounds like employee manuals. That sounds like time, grooming people. But you guys were still newer to the space in its own right. So it's kind of a build it as you're flying it process. Is that right?
Yeah, for sure. And a lot of the people that we hired over the first 5 years came with little to no real estate or even commercial real estate experience. And that was done intentionally because we wanted to have the ability to train them on how we saw fit and sort of focus on the areas that we did. Right. And from that, they grew their business. And then, then they brought their friends on. And it's sort of been a big residual factor that way, with a lot of people bringing on, close friends and family members and type of thing who also had the same passion for the business as we did.
Was there an asset class in particular that you said, man, this is what we're going to focus on as brokers?
Up here, in the early 2000s to late, 2010, 2012, development land sales were really, really hot. And that made up a lot of brokerage business, was getting into that. Recently, over the past 3-4 years, and COVID has put an additional emphasis on this. Obviously, industrial markets are very, very tight. In BC, we suffer from a lot of land constraints in a lot of our markets from waters and mountains. So they're just not making any more land, and that's really pushed the pricing up. So from a brokerage standpoint, we have your office, your retail, your industrial, but development land early days was a big focus of ours. And then we also focused on the leasing aspect because a lot of brokerages and brokers didn't want to do leasing. Right. So we thought that, hey, if you own a building, you got to fill it. So we focused really hard on the leasing aspect, built the relationships with landlords through leasing, and then eventually they wanted to buy or sell. And we kind of became that first point of call.
Right. No, I love that. That's really, really cool. Tell me, when it comes to acquiring your own assets, I mean, this is something, we talked a little bit about off air. Are you guys also active buyers?
100%. So from a company standpoint, and I think when you look at the McDonald's of the world and you take kind of the not broke, why fix it type of thing, from a brokerage standpoint, we try to acquire as many of the buildings or office spaces that we go into. Twofold, because it's a great model and we're putting our money where our mouth is. When we're opening these offices in these markets, we're investing our own money there, which I think creates confidence both in our brokerage community, but also I think from the client base. But then I think at the same point in time up here, we've seen a lot of hike in lease rates quite a bit over the past 10 years. An office space in downtown Vancouver might have went for $15 to $20 10 years ago, and now it can approach $55 if you go into the right Class A building. So by us acquiring them, we're almost giving ourselves the ability to protect our business 10 years down the road, that we're not subject to seeing our rents double, and then we get into the position that we're just working for landlords at that point. So we definitely try to acquire it, and also when we go into communities where we're not currently active or we're looking to go into, we try to acquire real estate in those marketplaces as we're going in, because again, we believe in those marketplaces. We echo that to our clients. We encourage our clients to as well, because we're seeing trends happen now that if we can fast forward 5 or 6 years, getting in today probably is a good investment for everybody. So we encourage our clients to partake with us when we acquire assets in those markets.
Now, are you acquiring, what I'm hearing you say is that you guys are acquiring only the real estate you are physically occupying. Is that right? Or are you guys acquiring other assets as well?
Other assets as well. So we try to acquire our own assets for our company, but then also we believe in these markets. There's a reason why we're opening the brokerage in these markets, because we're seeing uptick in population and trends and jobs. So we kind of have a thing up here where commercial real estate kind of lags the population growth. Developers go in, they acquire the land, they put up the condos. Shortly after that, commercial space becomes in higher demand because we offer a place where jobs are. So we try to get in early enough in that cycle that as we're seeing developers start to buy up land, we are also trying to acquire assets, whether it's an office building or even a retail strip center in these marketplaces, knowing that if the trends continue 5 to 10 years down, we might have some prime real estate in these markets where we have a major jump in our rents, which obviously, as demand goes up, capitalization rates come down, and that just pushes prices up, gives us the ability to refinance and go on to the next market.
How do you acquire assets in these markets and yet protect the interest of your clients?
So when we look at these markets before we go into them, we're monitoring them usually 2 to 3 years prior to us actually going into them. While we're gathering data on that, we share all that data with our clients. And when we're sitting there and we're promoting a small market, say like a Victoria or in Vancouver Island up here, we're telling them to buy there. These are the metrics why they should buy. And also at the same point in time, we're also acquiring real estate assets there. Clients always come first and foremost. So if there's an asset class or a building that a client has an interest in, 100%, we take it to them first. If we've taken it through the list of clients and no one has decided to buy it, we will definitely look at the asset. And if we feel it's a good purchase, we will. A lot of times too, we're getting into the markets early enough where there's not really a high demand just yet for it, because there's not the buildings built yet, or the employers haven't shown up just yet. So there is some bumpy roads that we do go down early on in the process, but 9 times out of 10, when the things all sort of play themselves out, we're in a good position.
How do you project the future growth in these markets where, like you said, maybe the employers haven't shown up yet, or the writing isn't on the wall for everybody to go, oh my gosh, this is the next best place to be? Like, how are you feel like you're getting in front of that?
Well, we obviously have a front row seat to see what developers are buying where and why they're buying there. We also monitor population trends quite a bit. And we also look at a lot of a lot of communities that maybe only had 1 or 2 pillars to support the economy. Now there could be 4 or 5 pillars that could support that economy. So we look at that very early on when we're watching these developers acquire land, major developers acquire land, knowing that these things are probably 3, 5, or 10 years out. Right. When we start seeing those trends happen, that's when we'll start looking at marketplaces quite seriously, not just from an acquisition standpoint, but also a brokerage standpoint. And again, when we're going into these markets, we're telling clients, come with us, and we're sharing the data with them, and we're telling them why we're buying it. Some of them feel it's a little too early for them and they don't want to go down that rocky road just yet. Other clients, they feel confident that if we're partaking in that, then it's a good investment for them. And we've been very fortunate. A lot of clients that bought into some markets early days when we were first looking to acquire in those markets, 3 years later have done extremely well. Some of them have even doubled the value of the real estate because now the boom has happened and now people are coming in, and we've been fortunate to get there early enough.
Right. I love that. Is there an asset class you guys are not actively investing in because you're just unsure of where it goes?
Well, we look at all asset classes in these marketplaces to find out. Like some markets, we like industrial better because there's lack of supply, higher demand. Other markets we'll look at, how much square footage of office does that market currently have versus the population? Some of these smaller markets, especially in the office class and the retail asset class, you're more subject to a repositioning of tenants than new businesses coming into the market to backfill it, like you'd find in a major city. So location becomes, is premium especially when you go into these smaller markets with that. So we look at everything from a population to a demand to, how much square footage is available in that asset class, mainly so we don't run into a situation, say like Calgary, Alberta did, where they had, I think they had like 18 million square feet of office space and the market just never ever caught up. And then when the oil collapse happened, they've got, acres, unfortunately, of empty office space there. So, we really, really monitor it on a case-by-case basis. It's very unlikely we ever look into the multifamily marketplace just because of the triple net rents that don't exist. But we're open to whatever makes the most amount of sense, depending on we feel where that market's at.
When you say the triple net rents don't make sense, because I guess they're obviously not there.
Correct.
Is that all you guys are investing in is triple net properties?
More or less. And mainly up here, we've run into some challenges. Demand for the multifamily asset class is huge. Right. Cap rates you've seen in the greater Vancouver area as low as 2.5% about a year ago. 3%, 3.5% is more common you see now. But we've had a huge increase in our insurance costs, property taxes, all of those costs that we can't recoup through it. So not that it's a bad investment model, it just doesn't fit what we look for, and we feel more protected with the triple net type asset classes we go after.
How are you protecting against inflation in a triple net lease? Is there something you're writing in your leases that say, hey, we're going to reprice based on this metric? What does that look like?
So our triple net costs up here in a lot of leases, they will recalculate on an annual basis. Our base rents, obviously, we're protected through that. But our triple net costs, it's a fluid cost for us as landlords. So every single year, unfortunately, if we're seeing a 6% increase on property taxes and insurance and strata fees and garbage and water, that all gets passed on to the tenants. Part of our strategy when buying is buying into markets where we feel we're at the bottom of the barrel lease rates, where we might be getting $20 or $25 a foot base. And 6, 7, 8 blocks down, they're getting 40 or 45. So we feel we're getting into that position at the bottom of the barrel. So even in if we can make our numbers work at those low lease rates, and we ever have to support a tenant through maybe a major increase in property taxes the next year, we're in the position to do that versus coming into a marketplace where we feel our lease rates are kind of peaking, and then we're really dependent on our tenants being successful at that point.
Right. Yeah. And I guess that's the, and you answered that to a degree on things such as property taxes, insurance, things like that, that you don't have control over. Obviously, but on inflation as a whole, is there like, hey, it's, I don't know what the Canadian version of CPI is, but it's like,
yeah, we use CPI.
Okay.
Same thing.
Yeah. So, do you tie it to that and say, hey, your lease, if it was $100 last year, I'm just making up numbers here, next year it's going to be 108 because we had an 8%, consumer pro whatever, inflation rate here in the last 12 months. Is that the kind of the way that works?
From time to time, you'll see that. Normally when we're negotiating for the base rent rates now, we always try to build in a step up throughout the 5-year term, where maybe they're paying $60 today, 62 next year, 64, 66, and 68. We're hedging our bet by doing that, not knowing where the inflation rate comes from. But we do see sometimes leases will be tied to CPI, or even the renewals will be capped based on CPI during that fixed term. That way we can all, it kind of helps both sides of the equation. But we're in a very high demand market in BC that we're very fortunate that if a tenant leaves because they can't afford the $45, then 3 more guys are willing to come in and pay 50 to get the space. So we're a little jaded up here how that works.
Right. Yeah. It's nice to be in that position there in BC, but you guys are buying, outside of BC as well. I mean, you guys are buying across the country. And so you kind of have some exposure in some of these smaller markets, maybe where that demand factor isn't quite as well priced in.
For sure. Yeah. And that's, you're exactly right. And when we get into those smaller markets, it's just, we will do our best calculated guess of where we're going to see things go. The tenant pool isn't as strong to draw from. And usually the tenancies aren't as strong and the covenants aren't as strong. So we'll do our best to try to make the best educated guess. But first got to tell you, we're not always right.
Yeah. I mean, and who knows, it's anybody, and we talk about this, and there's a question I've asked multiple times on this show, and I always get a varied response, especially people who are mostly in triple net leases. How are you guys protecting yourself? And I like the way you've explained that. So that makes a lot of sense. You make your best guess, and then it is what it is for 4 or 5 years.
Yeah, exactly. And I think if we all had the crystal ball of where we were going to look in 5 years, we'd all be billionaires, and we probably wouldn't be doing this today. We'd all be having a beer in the Caymans. So, we just got to go with our best guess.
Absolutely. I love the sound of that. Tell me about the complexity of opening a new brokerage in a new market with a new team.
There's challenges with it for sure. We've been fortunate enough that we've sort of grown organically through our own team members. So when we're going to other markets, say, like we have our Vancouver office and we'll go open, say, in a Kelowna marketplace, which is about 4 hours away from us. There's a good chance people in our Vancouver office know brokers that already operate in the Kelowna market. And when we go in there, we have revenue sharing programs for our staff. We have profit sharing programs for our team leaders and managing brokers. So I'm a big believer that, it's better to have 50% of a watermelon than 100% of a grape. So when we go into these markets, making them a part of our success and getting them to focus on the same parts that we're focusing, we profit as a team. And that's where we've been very fortunate, where people that can partake in the revenue sharing programs from the company that don't really exist in our industry too much. It's a great feature for a lot of these people to take part in. So that's where we've been very fortunate to get some great people to join us early on.
Yeah, I haven't really heard of that in any brokerage, arrangement, where either on the residential or the commercial side. Where
it's very unique to our industry. And I think, we're only as good as our people. And that's, and for us, one reason why we've been able to grow at the pace we have is we've been able to retain a lot of our people over the years. And a lot of times in the brokerage business, you see a lot of people like 2 steps forward, 1 step back, where people are changing brokerages and administration staff are leaving. So I've always been of the belief, if we pay our team right and we treat them right and we incorporate them into our overall business model and they can profit right along with the company, it keeps our retention levels very high and creates a very unique corporate environment to work within. So when we are looking to open up another offices, a lot of our brokers are eager and excited to reach out to people they know in those markets to tell them about their success so far. Gets them excited to come join us and meet with us. And we've been able to scale the models quite quickly, maybe more so than other brokerages in some of these smaller markets we've transitioned into.
Yeah, I love that. I love finding unique ways to incentivize employees to share in the rewards of the work, not just to get a check or not just even to get commission, but hey, retain part of the, maybe not ownership shares as directly, but at least participate as an owner normally would.
Exactly. Yeah, they profit right along with us.
Were there any surprises, or were there any kind of tweaking of that model as you built that over the years?
Well, we typically, from like a revenue sharing standpoint as well, we do it off the top line versus the bottom line. And the reason why we do that is because it encourages our team, where their focus is selling and leasing product for clients. They're tied right into that versus me making a really bad lease deal or a really bad acquisition in a market. They're not penalized because of that. So we do it off the top line type of thing. Obviously, when you take that model and that approach, you've got to be very confident in your bottom line because there's no guarantee you're making money. But we've been very fortunate that we've had almost 100% growth year over year from a top line sales revenue over the past 5 years. We've been able to sustain that. And because we focus on a quality versus a quantity model, our offices might only have 6 to 8 team members in a particular marketplace where there's not 50 or 100 of them. So for us to have top line revenue sharing, we don't have an enormous staff to have to share that with. So it gives us the ability to give back to them that way. Versus if we had 400 brokers and everyone had 1%, well, 400% is greater than 100%, we'd be in a lot of trouble. So it works well with our model.
Right. I love it. I love it. Cory, thank you for taking the time to come on today and really just tell us about your business, your kind of thinking as it pertains to incentivizing employees and, doing revenue sharing with them, talking about the markets you guys are investing in, how you vet and see opportunity coming down the line, and, how you guys are protecting yourself there in triple net leases. You guys are busy, man. You're absolutely busy. I love it. And
Very fortunate.
I appreciate you come on the show today and sharing with us. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
They can visit our website at williamwright.ca. On there, they can sign up for all the latest listings and transactions and information. We publish quarterly reports. We also have the Vancouver Commercial Real Estate Podcast, which we bring on great guests on a weekly basis to help educate the general public. Because I think there's a mystique out there that commercial real estate, especially in Vancouver, is very hard to acquire or own by big businessmen in New York. And we've really tried to break down that barrier and explain to them that this is an opportunity for everyone, whether you're a small business owner that's been in business for a while with great revenue, all the way to the mom and pop type owners that might have a little bit of extra equity in a property or even cash in the bank, how we can hopefully open up those doors by bringing on great guests to educate them on how that works and show the people that commercial real estate is available to everyone.
I love it. Cory, thank you so much for your time today. I appreciate it. Have a great rest of your day.
My pleasure, Sam. Thanks so much for having me. Take care.